Major funding for these broadcasts has been provided by grants from Madison Realty Capital, New York Community Bank, M&T Bank, AmTrust Title, Customers Bank, Ariel Property Advisors, Capital One Bank, Sterling National Bank, Marks Paneth LLP, Meridian Capital Group. Additional funding has been provided by grants from Amarant Bank, AVR Realty Company, Bank of America Merrill Lynch, Briarwood Organization, B6 Real Estate Advisors, CBRE, Chase Commercial Term Lending, Chase Mortgage Lending, Citizens Bank, Collins Building Services, CPEX Real Estate Services, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handro Properties Handler Real Estate Organization, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, Kilroy Architectural Windows, Matone Group, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Group, RPW Group, SJP Properties, Stonehenge NYC, TD Bank, Terra CRG, the Merringore Family Foundation, and these friends. Where are we today? Where's the money? What's it costing to finance real estate? Where are the lenders? Who's doing it? What are they like? What do they dislike? I don't know the answer. So today, with the help of my friend Mr. Levine, I've assembled a group of prominent lenders to talk about where the market is, the capital markets update for 2019. My guests today include Mark Waldman, Managing Director at Ladder Capital, Barry Seidel, Co-CEO of Keysight Capital Partners, and last but not least, as I was saying, my favorite executive producer, Ronnie Levine, who is the Senior Managing Director at Meridian Capital Group, LLC. So since you've done this for me a couple of times, where do you see the money rates and the different aspects in 2019 at the beginning of the year?
Sure. Look, I mean, rates are still historically low. I think it's a very good time to be a borrower. A lot of capital in the market. I think an answer to a question on rates needs to be a little bit more targeted to, permanent financing, 10-year money, 5-year money. But generically speaking, you're looking at, I think, the 10-year Treasury is right around 2.7% as of this morning. Banks are lending in that kind of 5 to 7 year space in and around the low 4% fixed rate type of money. Life insurance companies are lending money for low leverage assets, inside of 4%. So, like I said, there's a lot of liquidity in the market, and there's a lot of competition from the lenders right now.
Barry, tell me what you're doing and where you see the market and how high in the stack and what assets you like.
Well, our business, Keysight Capital Partners, is focused exclusively geographically on New York City. So there's a very narrow focus and observation, but we play particularly in the subordinate space, although we'll also do the whole debt structure in some cases. And we try to be very attractively priced for our clients, and we're in the mid to high single digits. We're doing long-term
mid to high
fixed rate.
single digits. Is that 6 or is that 8 or is that
It's around today. It's around 8, and our rates are pretty sticky. We don't move basis point to basis point with changes in treasuries or the market, and that's a function of our capitalization. capitalized by an institutional partner and gives us a lot of stability and the ability to do things in a good way for our clients. Very relationship oriented, so we try to work with family offices and private owners of real estate, people who've owned things for a long time, and try to give them a creative solution.
And Mr. Waldman, you're with a public company.
I'm with a public company, Ladder Capital, $7 billion of assets, and we have 4 business lines. The first 2, which I spend most of my time in, are balance sheet lending and also lending in the CMBS business, fixed rate loans on stabilized assets. We also buy securities, predominantly CMBS, both floating and fixed, and we also buy commercial real estate. But at our core, we're lenders, and I guess the 2 businesses, they're both very competitive. As Ronnie said, there's a lot of capital. There are a lot of lenders chasing what seems like a dwindling supply of deals. And on the balance sheet side, we lend anywhere from, call it L3, 325 up to, double digits on certain, pre-development deals,
Are you
land
competing?
loans.
Are you competing with the alternative lenders, the private equity funds?
We tend to bump into a lot of different players because we will do loans. We'll do a balance sheet loan that's $150 million. We'll also write a $10 million balance sheet loan. So we bump up against kind of smaller guys, and we also bump up against banks, larger banks, more other public companies, mortgage REITs, larger debt funds. So we kind of see everyone on the playing field. And on the CMBS side, we compete against a lot of the large commercial banks and also non-banks as well.
Do borrowers prefer balance sheet versus CMBS lenders, securitization?
Absolutely. I mean, I think most borrowers would tell you they would definitely prefer to be in a balance sheet product. I think the big knocks against CMBS historically have been, the loan closes, the lender sells that off, and then there's a servicer that comes in and you're dealing with a nameless, faceless servicer that has no connectivity to the loan. So things like lease approvals and accessing dollars in reserve accounts can be difficult. But CMBS offers things to borrowers.
For my viewers who are not understanding inside baseball,
Yeah.
explain what CMBS is.
Sure. So CMBS stands for commercial mortgage-backed securities, as opposed to RMBS, residential mortgage-backed securities. So basically, lenders make loans. They aggregate a pool of loans, and then they sell those off as securities. So they create bonds and they sell them off their books. So the lenders basically warehouse the loans for a short period of time, and then they sell those off in a bond offering. So once those loans are sold off their books, and some lenders can pool collateral with other lenders, and then they sell them off, those loans are then serviced by companies like Wells Fargo or Midland. And so when you have questions or need something from your lender is, if Mark did a loan for you at Ladder Capital and 2 years later you need to get a lease approved, you're not going to Mark at Ladder Capital, you're going to Midland. Now, a lot of CMBS lenders have tried to address the servicing issues, so I'm not sure if Ladder has this, but a lot of lenders have now a dedicated point of contact within their firm to help you navigate the servicer.
Now, what happened a couple of years ago when they said we want the CMBS lender to have skin in the game? Is that still around today with like the 5% rule, Mark?
It is still around. So if you are securitizing today, there's risk retention, what it's called, and you have to hold 5% either what they call a vertical or a horizontal. So effectively, you could be holding the bottom 5% risk piece, or from AAAs all the way down to non-investment grade. So you'll see some securitizations are done with a vertical execution, some with horizontal. We've done mostly horizontal, and you see mostly banks that are doing vertical, and they're holding the bonds on their balance sheet.
Now, how much of your business is balance sheet versus the collateralized mortgage?
Well, last year we did roughly 50-50.
And where do you see 2019?
Probably the same. Probably the same.
All of our business is balance sheet. We keep everything that we do on our books, and that's our clients, the kind of relationship clientele that we have really appreciates that. So our whole approach is to build a long-term, repetitive business relationship with the borrowers. Whether it's a 5-year or a 10-year hold, those clients will always have my partner Bruce or I to call, and we're always going to be there answering the phones, whether it's something as small as a lease approval or anything else. as I said, we're primarily, though not exclusively, a subordinate lender. So we do a lot of mezzanine or B components of mortgage loans. And we work with senior lenders who have the same balance sheet approach. So the kind of the regional middle market banks more than others who have those relationships and answer the phone when their clients call.
Looking at your PowerPoint presentation and your website, I saw that you did a number of, let's say, B-plus office buildings or A-minus office buildings in New York City. How'd that happen? Are they transitionary assets?
I think most of our balance sheet is spread across the country. So we're actually not that heavy in New York City on our balance sheet, and I think that's really due to the fact that New York is very competitive, and we find we can find better returns outside New York. Now we still have done hundreds of millions of loans within New York City, and we continue to do loans within New York City, but it's really spread out across the country.
What about the hospitality loans that I noticed?
Yes, at one point we had 3 hotels on our balance sheet in Brooklyn. We did the McCarran Park Hotel, we did the Pod in Williamsburg, and we also did the Box House Hotel. We also did the Fairfield, which was a securitized loan. That was about 3 years ago.
Ronnie, how do you see the appetite today of other lenders with regard to the hospitality?
I think the appetite for lenders is very specific to the flag that's being, the flag of the property, who the owner operator is, how much history the asset has. I mean, generally there's still a negative bias towards hospitality from the lending community, so the story's got to kind of check a lot of boxes for the lenders to want to do it. But the more operating history you have and the more comfortable the lender can see how the property performed during the downturn, and what it looks like, the big issues in the city for hospitality are really the union costs. So the labor costs are very expensive. And it's a competitive market. But I think we've seen some
You also
rising...
have to realize Airbnb is another competitive effect on the hospitality market.
Yeah, but I think the most recent data shows, modest increases in RevPAR, and I think there is some positive news in the hospitality sector. I mean, we're working on a ground-up hotel construction loan right now in, kind of in Midtown South area, and we've got plenty of interest in it. It's just a question of, pricing and proceeds. But, operating hotel in the city with a major flag for a proven owner-operator is going to get financed.
There is this perception that bricks and mortar retail are dying. I don't believe it is. I think in certain markets it's really strong.
Sure.
How do you see the retail market, you as a lender, both balance sheet and as the securitization?
Sure. I mean, we're careful. I mean, we pick our spots. I think there will be winners and there will be losers in the retail space, and you want to finance, when you're outside New York City, you want to finance the centers that have the right tenancy mix. Everyone loves grocery anchored shopping centers, but if you're financing even a power center, who are the tenants in that space? Do you think they'll be around in 5 years, or will they not be?
I mean, if you just look, the Gap is closing all their stores, People are very happy financing a Target or a Burlington. The discount retailers continue to be doing well. The off-price retailers are okay.
I think historically, when you saw rents in Soho and some of these markets reach a level that wasn't sustainable for the smaller tenancy, they got priced out. A lot of those stores went out of business. The major retailers came in, were paying, you might argue, irrational rent levels that aren't sustainable. Those stores weren't profitable, and now a lot of those leases are coming due, and those tenants either will stay at a lower rent or are going to leave. So, what we see is, a lot of the leases that have been signed in Manhattan have been, fast casual dining seems to be popular, retail sector that seems to be growing. Some of the more boutique fitness concepts have been leasing space. A lot of the vacancy is being held by landlords that are honestly holding out to get a certain rent level that's not there in the market right now. And the question is, will rents get back to a level that they want to transact at?
Another topic that people really are talking about, in a negative venue is condominiums, okay? Condos. Where do you see the appetite of lenders, yourself, and in the market today with regard to construction financing for condominiums? Mark?
I mean, we're not active in that space just because we're not a ground-up construction lender, so we're not really seeing packages for condo financing these days. But it's definitely, from even we see a lot of condo inventory loans, and when you see a pickup of condo inventory loans, that means condos are not selling.
We do
or
as
not
well.
selling fast enough, and I think that seems to be the case right now in the city. That you don't have the velocity.
But you bring up an interesting topic: condominium inventory loans. I've seen a significant increase in the number of condominium. Would you finance a condominium inventory loan?
We would. At the right
basis, then no problem.
At the right basis, we would finance we would finance anything.
Right.
We have a different take on it. We see a lot of them also. And on one level, we would finance condo inventory loans, but only if they're sort of treated as a multifamily within a condominium, that the owner is deciding to lease them up.
You want, as opposed to most people who like condo inventory loans, where they aren't leased up because then they're a resale unit. Okay.
To us,
there's two different opinions of you.
For us, that's more akin to a bridge loan. The idea is to liquidate those loans as soon as possible, and that's not our role. But if it's a longer term hold, then that's something that we're helpful with.
I mean, it works as a rental.
Yeah.
We've done financing that's kind of a hybrid of that, where sponsor has a leased pool of units that they want to continue to sell over time, but it does work as a rental, so you can bake in release
But that's one
provisions.
venue. The other approach is the vacant condominium units of a new development.
We've done plenty of that financing, and I think you started out asking about condo construction in general, ground up, but I think, people are saying basis, and I think basis is certainly the driver for that lenders look at. But I think that what you've really seen becoming more prominent in the lenders' analysis now is absolute price points. So yeah, the basis per foot is a number that people care about. Is it $1,500? Is it $2,000? Is it $1,200? But right now, what percentage of the unit mix is more than over $3 million in prices? So people now are more focused on what is the sticker price of the units here. The very expensive units are moving very slow. So lenders would much rather finance a project that has a lot of $1 million to $4 million units than $4 million units.
Right,
to $10
where
million
the price
units.
point
But
is
even
could
if
be
the dollar
acquired.
per square foot is the same on all the product, it's just a question of the liquidity of the $1 million to $4 million units. They just seem to move faster.
How do you see the New Jersey market, the waterfront, and the rest of the state of New Jersey in general?
There's a lot of new supply.
Yeah, I mean, I would commute, via the ferry at Port Imperial and Weehawken for 4 years when I worked downtown, and the
Proud of
growth
that.
there is absolutely incredible.
Right,
In terms of rental
Weehawken-
buildings, condos, and
Right.
they're building 2 hotels now that Matt Calley's building. So there's a lot of action there, and I think people want to live there. In Jersey City too, people want to live there. Jersey as a whole, we do business in New Jersey. I think you love multifamily because it's very hard to build, especially northern New Jersey. There are no sites. Retail is also very healthy. Office is different.
I recently did a show on Westchester, and the Westchester office market had always been like the New Jersey market, basically terrible, and it hadn't increased in price for about 20 years. What has happened is a significant amount of office space in Westchester. There was 32 million square feet of space converted to residential or knocked down to residential. So the vacancy factor has really gone down to like a 13% number. Regarding that, how do you look at transit or financing for transit-oriented developments in New Jersey, in Westchester, and Long Island? Ronnie?
Look, I mean, transit-oriented developments have been kind of a buzzword for many years. I think lenders look very favorably upon transit-oriented developments. Rental properties, multifamily is, there's been a lot of emphasis around, building up in kind of, transit markets and ease of commuting to Manhattan or wherever the major kind of business drivers are. I think it's important, and it's certainly a lot easier to get a transit-oriented development finance than something that may just be more, more suburban.
So since Barry and I are the oldest in this room, okay, what's your thoughts as lenders in general with regard to senior housing? Have you done that?
Very little. I would say that's, and Ronnie could speak to it more because on the brokerage side, but it seems to be done predominantly by banks, and also, Fannie and Freddie and HUD are involved in that business. But from CMBS, we're not really. That's more of an operating business, so it's not.
It's a
doesn't really fit the
multifamily
CMBS
business.
mold.
It depends on the services being provided. I mean, we've also done just age-restricted rental properties, 55 and over communities that really
Right.
have no services. But, stating the obvious, it's a growing sector of the market. As the population ages, I think you're going to see more need. And we think it's a very important sector for us to be focused on. We have a whole separate team at Meridian that does nothing but senior housing. So because of that, it's not something I'm working on day in and day out, but we're very focused on it.
Let's talk about student housing.
We do student housing, both CMBS and balance sheet. There have been struggles within that space. Only across the country there have been oversupply in certain universities because it became a very hot product, and so you had a lot of developers that have been building, really nice product, but further and further away from universities, and you've seen some distress there recently over the last year or so. But overall, it's considered a part of the multifamily space. So you have Fannie and Freddie aggressively bidding loans in that sector, and CMBS as well. So there's a lot of liquidity in that space.
So we look at student housing the same way we look at senior housing and hotels, which is, it's not in our business plan because they're operating business. Same reason you feel that way. And because we're geographically New York City only, but it's interesting because a good number of the buildings in some of the portfolios that we financed around Morningside Heights, around Columbia, around NYU, are effectively student housing because they're full of roommate sharing. So even though we don't see it as an operating business per se, the reality is that the market's taking care of itself.
Look, I mean, I think in Manhattan there is a lack of student housing. It's not representative of the rest of the country. I think due to just the cost of construction here, and there's every university is looking for housing to the point where some of them are going out of Manhattan further and further out onto the mass transit systems. But we see a real need for student housing in the city. And we see a lot of developers that are building sites, any land they can find up by Columbia. They're building market rate rentals that are geared towards students. I mean, the student housing model, what I guess differentiates it from a traditional multifamily is you can lease by the room, and you're typically getting a parent guarantee on a lease, and you've got maybe a 3-bedroom unit that has 3 different. So
basically, we're talking about co-living in a different aspect.
I mean, it's basically what it is. The real traditional student housing is co-living.
So here's a question. With WeWork being the largest tenant in New York City, and a number of other co-working companies out there, how are you seeing the financing market where the significant portion of the tenants are co-working companies?
There is definitely a concern on in the lending community about co-working. I don't think anyone argues that it's here to stay. I think you're being naive if you don't think that the trends in the office market are certainly pointing towards co-working being a significant portion of the office.
Right, but the world changes if there's a recession and so on. Okay?
So the lender analysis that we see most often is, forget what that tenant is paying, the co-working tenant is paying. What happens, we need to underwrite this back to what we feel comfortable the traditional office market can support. So they're going to underwrite that space at what they feel the market rent for non-co-working, just traditional office space.
I'll give you a good example. I was looking for space, and I went to not a co-working company, an office share tenant, and I looked at space, and the guy said to me, look, he was honest. I had him on the show. He said, I need to get $110, $120 for this space. I said, what are you paying? He says, I'm paying about $40. I said, I understand your markup and everything. I said, but you're at $40. So you'd underwrite the loan at the traditional $40 as opposed to the $110. How about you? Have you done much work on co?
I mean, we've done office buildings that have had WeWork in them or Notel, and we look at, like Ronnie said, you're going to look at the building, you're going to look at the asset, you're going to look at your loan basis. Would we do potentially a single tenant, co-working building? Probably not, but if they're paying market rent.
Do you think the CMBS market is interested in buildings that are, let's say, significantly co-working tenants?
You have seen,
I didn't say you with Ladder, I'm talking
but in the
general.
market, there have been buildings in the city that have been financed that were single tenant WeWork. And I think you're looking at sponsorship, you're looking at the loan basis, and people want to feel comfortable that worst case, if that tenant blows out, like any single tenant analysis, you're going to take a look at, if that tenant does not exist, am I still covered on my loan basis? And you'll look at dark value. So if your loan is 400 a foot and dark value is, 450, you feel good. Even though the value with that tenant, is 650 a foot.
So if I'm looking at my Apple, the big one and the small one, the outlook for 2019 capital markets seems it's pretty shiny. It's not a little dull, right? Mr. Levine, would you feel that way?
I think it depends on whose perspective you're taking. I mean, I think, what I hear from the lenders that we deal with is that, it's a competitive market and that they are fighting tooth and nail to get deals, and it's very competitive for them. So I think the lenders may not share your perception of the market, but I think I
was talking as a borrower.
as a borrower, I think it's still a very good time to be a borrower.
Okay.
There's there's a lot of capital in the market. There's a lot of competition on loans, and I think it is a good time to be a borrower, but you need a good intermediary to help you navigate the market, Mr.
Thank you for the sales pitch. I'd like to thank the other gentleman over here, Mark, over here, Barry, and needless to say, the salesman over here from Meridian Capital, Group, Ronnie, and I'll see you next week.